Hey everybody, I am really excited about doing this video for you today. These are the 3 stocks I'm looking to buy August 2021. Now, all 3 of these stocks I currently own in my portfolio. So I own a very concentrated portfolio. I think the number of stocks I own right now is around 8 in my portfolio. So when I do buy a stock, I have very high conviction in the company itself. So we're going to go through each one of these 3 stocks. I'm going to tell you what percentage of the portfolio they currently are. I'm going to tell you what my goal is as I build them out, what percentage I want them to be in my portfolio. And each stock I do buy, I have an intrinsic value of that stock and a margin of safety that I want to buy the stock at. So I'm going to discuss what my buy target price for each one of these stocks are as well. And if you get some value out of this video, please smash that thumbs up button. Really helps out the channel a lot, helps out the YouTube algorithm. And let's just jump right into this thing. So the first stock I want to talk about, and it's my most recent purchase, is Corsair Gaming, ticker symbol CRSR. This was on my watch list for several months. So I started actually buying Turtle Beach back, I guess it was December of 2020. And Turtle Beach is a competitor of Corsair Gaming. So I know Corsair Gaming very, very well. So I was watching it very, very closely. So Corsair Gaming, just like Turtle Beach, sells gaming accessories, except Corsair is actually a bigger company. They're around a $2.7 billion market cap right now. Currently, they're trading at a PE of 18 and a forward PE of 16. So I personally think this is dirt cheap for this company. They are in the tech sector, and gaming, I would say, just in general right now is just getting, I guess you could say, they're just very pessimistic, the investors are. In fact, Corsair is shorted about 6.1% of its total shares are shorted right now. I think a lot of investors are looking at Corsair Gaming and these other gaming accessory companies and saying, hey, 2020 was a total just oddity year with everybody staying at home. People were just buying games, gaming consoles. Keep in mind, like the PlayStation, Xbox, the new versions came out in November. So they just think in general that these companies are just, they're trailing 12-month PEs, for example, are just overstated. And I got to tell you, I do not believe that is the case at all. In fact, Corsair, they're trading at $2.7 billion market cap. They're playing between $1.9 billion and $2.1 billion of revenue for 2021. Analysts think this company is only going to grow between about 10 and 13% in 2021. However, just on the revenue alone, they're supposed to grow between 15 and 20% is what the company believes they're going to grow. And EBITDA is supposed to grow almost 25% for 2021. So I think analysts have this completely wrong. I mean, I look at the other companies in their sector. For example, Logitech, they think Logitech is going to grow 30% over the next 5 years. They think Turtle Beach is going to grow 16% over the next 5 years. They only think Corsair is going to grow like 10 or 11%, and that is just not simply the case in my personal opinion. I'm not a financial advisor, so make sure and do your own research. But in Q1 alone, they grew over 70% revenue. They grew 400% operating income. They introduced 29 new products in Q1. They introduced over 80 new products over the last year, and that's supposed to continue to grow as they go through this year. Now, this company is a recent public company. They've been around for, well over 20 years. In fact, they were founded back in the 1990s, but they became a public company October of last year. And again, I just think there's a lot of investors out there, a lot of hedge fund managers just think that 2020 was an oddity just in general. So I think their stock price is suppressed quite a bit, just like Turtle Beach is. However, if you look at this company, their balance sheet, they're hanging around $120 million of cash. Now they have around $270 million of long-term debt. So some people may look at it and say, it's a lot of long-term debt. But if you just go back 9 months, they were at almost $500 million of long-term debt. So they were able to pay that down. In fact, if you look at Q1 2021, they had about $28 million of free cash flow. And they actually took that free cash flow and they're putting it towards long-term debt. So that's kind of what their strategy, it seems like, is right now, is just paying down their debt. So they're actually paying it down very, very quickly. And if you look at their free cash flow, $28 million. If you project that out for the year, they should be well over $100 million of free cash flow. So based on that, they should be able to pay off their long-term debt within 2 years based on their free cash flow. So that's looking really good for the company. One thing to keep in mind too, in 2020 alone, there was over 100 billion watch hours on YouTube around gaming. And so you could think of, just Corsair and the rest in gaming market just in general. This is supposed to grow tremendously. You're talking, between 12 and 20%, over the next 5 to 10 years. Corsair in 2020 sold 33 million units of their product, and they're estimating about 2.8 billion people worldwide are into gaming. So you can see they just have a small pocket in the market. And with only $2.7 billion market cap, I think they have a lot of runway to run. I mean, their closest competitor is Logitech, around $20 billion market cap. Turtle Beach, like I've talked about a couple of times, they're around a $400 million market cap. I think Corsair is in a really, really good position to grow in the future. In fact, they actually acquired 3 different companies here in the last year. I think that's going to continue to grow in the future, but I think they are just in a really good place overall. So now, as a buy target price, I think anything under $30 a share is a really good value for this company. I recently did a short video, I think it was like 40-50 seconds long, doing intrinsic value on Corsair, and I think they are worth around $38 a share based on a 15% discount rate. So I think anything under $30 is a buying opportunity for me. Currently, they're around a 5% of my portfolio. I really want to build that out. I want to make it at least a 10% of my portfolio. Now, their earnings are coming out this week, and I expect them to demolish numbers. So we'll kind of see where things will go from there. But hopefully the stock price stays down for a while so I can buy more. So that's Corsair. Now, second company I want to talk about is Alibaba, ticker symbol BABA. Of course, that one's been in the news like crazy lately. All the Chinese companies have. Alibaba really is one of just a few companies, I think, in China that I would be willing to buy into. I also own Pinduoduo as well. They have an interesting business model, but I think Alibaba overall has, besides Tencent, has the best business model in China. So Alibaba owns a bunch of different subsidiaries. I mean, they have Tmall, you have AliExpress, they own a third of Ant Financial. It is really impressive. I watched a documentary on Jack Ma and how he founded Alibaba back in 1999. And he really did it for the people of China. He really wanted to bring the Chinese out of poverty, and he wanted to build really an e-commerce business where people could go not only sell on Alibaba.com, but they could also buy product from one of his companies. They could get finances from another piece of their company like Ant Financial, and Alibaba really touches every single one of those transactions and makes a good amount of money off it. Well, also promoting the Chinese, out of poverty and into the middle class, and that's what we're seeing right now. And I hear, obviously, there's a lot of risk with Alibaba. Don't get me wrong with that. But one thing I hear over and over again is that Alibaba is a dying company. They're not a growing company anymore. They had 64% revenue growth year over year in Q1, which was just phenomenal. Not only that, but their guidance for 2022, and keep in mind their fiscal year 2021 ended in March, so it's kind of a little odd, their calendar year. So 2022 is right now for them. They think they're going to grow revenue 36%, which is, so if you're going to tell me that they are a dying company, I'm going to laugh at that. They are a huge growing company. They're around $500 billion market cap. And it's really hard to find really good value companies right now in the market. And Alibaba is one of those companies. I mean, right now they're trading at a PE of 23. I think in a so-called normal environment, they should be trading between 30 and 35, even potentially up to a 40 PE. So at 23 right now, they are just dirt cheap. Their 4 PE is 21. And I know, again, there's a lot of risk with the company. They had a $2.8 billion fine last quarter. But my personal opinion, and I'll be coming out more Alibaba videos in the future, but I think there's a lot of FUD, fear, uncertainty, other things going on in the market where it's just pushing Alibaba stock down. And I'm not as worried, I think, as a lot of other people are around Alibaba. This is a company that touches the entire world. They have 1 billion customers worldwide. So they're not like a JD.com or Pinduoduo where they're focused on the Chinese market and that's it. They are global. So they have 800 million active users in China on the e-commerce side, but again, they have a billion users, billion customers worldwide. They still represent over 50% of China's e-commerce. One thing that is really, to me, underestimated about Alibaba is their cloud-based business. So they're spending a lot of money on CapEx to build out their cloud infrastructure. And right now, only 10% of the revenue is cloud. Keep in mind that I think this is going to be a big part of their business. Right now, they are the 3rd largest company in the world in cloud behind Amazon, Microsoft. I think in the next 5 to 10 years, Alibaba could be the #1 player in cloud, and I think it's going to be a much bigger part of their business in the future going out. However, in the meantime, as they build it out, it's going to cost them more money. It's going to eat into their free cash flow, but it's going to be big for them, big for their revenue, big for profits that people, I think, are not giving them credit for in the future. Not only that, but something that I think also is underestimated about Alibaba and a lot of these other Chinese e-commerce businesses is that the tailwinds in China are not like what we're seeing in the US. So US obviously has been the #1 economy in the world for a very, very long time. I mean, we're just, keeping at a very high pace all the time. We're just chugging out GDP like no other country that's seeing it right now. However, the Chinese marketplace, the Chinese GDP is catching up to America. Keep in mind, in America, we have 300 million people. China has 1 billion. So you're talking about 3 times as much people in China as there are in America. And more people in China are becoming middle class. I think it's somewhere, around, they're saying 700, maybe 800 million people will be in middle class here in the next few years. And if that's what's going to happen, Alibaba, JD.com, Pinduoduo are going to see their revenue and profits grow more and more and more as the Chinese become more middle class. They're earning more money. They can spend more money. So these tailwinds that are coming out of China, again, is like nowhere else in the world. And that's why right now, Alibaba is my #1 position in my portfolio, almost 30% of my portfolio. Anything for me under $200 a share is a great buying opportunity for Alibaba in my personal opinion. And I would make this stock up to 33% of my portfolio. So I have a little runway there, but I think it's one of the best buys right now in the market. And I know there's risk, but I think the reward is much, much higher than what the risk is right now. All right, so the third company I want to talk about is Sprouts Farmers Market SFM. So Sprouts Farmers Market is about $2.9 billion market cap. So not a big company, actually about the same market cap as Corsair Gaming. Sprouts Farmers Market is a farmer's market. They are in the natural grocers, organic type business. If you don't have a Sprouts near you, it's hard to compare them. I hear a lot of people talking about competitors like Whole Food Market. I've been to Whole Foods. I think Sprouts is very, very different from those. I think they're smaller. I think it's actually more open. I think the prices are better at Sprouts Farmers Market. Now, Sprouts Farmers Market is mostly down in kind of the southern region of the United States. I would say southern and then kind of south eastern part of the United States. So if you're kind of northern part of the USA, you probably don't have a Sprouts around you. Now, Jack Sinclair is the CEO of Sprouts right now, and he came on board here in the last 18 months. He was actually in charge of the whole grocery section at Walmart. So he comes with a background of being around the grocers market. So I think he was a really, really good hire for Sprouts. I mean, he's kind of looking at the business, and they kind of got out of hand when they became a public company. They started building stores left and right, and they kind of got away from like the small field type farmers market that they are. And so he's kind of bringing them back, and he's actually going to reduce the overhead of the stores by trying to reduce their footprint of the stores. Now, keep in mind, they had about $6 billion of revenue last year. So their market cap is quite a bit smaller than what the revenue is, but the grocery market in general is just that way. However, Sprouts is trading at a 10 PE right now, and they're trading at a 4P of 12. So that's actually looking pretty good. It's very close in line to what Kroger is right now, but Sprouts Farmers Market, I think, is actually going to grow more than Kroger. So Sprouts has been growing at a rate about 15%, very close on sales, earnings, cash flow. That should continue to go into the future over the next 5 years. This is a company right now that has about $250 million of cash on their books as of last quarter, and they have $250 million of long-term debt. So they could actually pay off all their long-term debt if they wanted to right now with their cash. Obviously, they're not going to do that. They're actually continuing to put in their business to grow it. They also announced in the last few months they're doing a $300 million buyback program. So they're planning to buy back 10% of the entire company, which is going to improve shareholder value overall. Currently, the company is at around 360 stores, and with the distribution centers they have set up right now around the country, they could still grow 200 stores very easily and not actually max out their distribution center. So they have a long leeway to run before they need to actually spend a lot more money on their infrastructure. So I think they're in a really good place right now. Going into the future, I think they're going to continue to grow anywhere from 12 to 18% per year over the next 5 years. And this company is heavily shorted right now. The market is looking at this company right now, just like Corsair Gaming, when they're saying, hey, 2020 was an oddity. They're looking at the same thing for Sprouts, right? When people were staying home, what were they doing? They were going to the grocery stores instead to buy food. They're not eating out as much. And so Sprouts and other grocery outlets, grocery stores saw their revenue, saw their profits spike up in 2020. So I get that, but I think people are not giving Sprouts enough credit on how much they've been growing historically, and I think how much they're going to grow out into the future. So because of that, almost 20%, I think it's around 17%, 20 million shares out of 118 million shares are shorted right now. That's a massive short. So what happens is when companies like this are shorted that much and there's any kind of upward movement, it's going to move up very, very quickly. And this company has been trading around 20 to 26 here over the last 12 to 15 months. I think that's going to continue until there's some kind of catalyst that pushes it up. And I think it's going to move very, very, very quickly. So right now, I think anything under $28 a share is a buying opportunity. For me personally, around 3% of my current portfolio is Sprouts. I'm willing to get it up to about 5% of my portfolio. And I'm personally going to be buying anything under $24 a share is a good buying opportunity for me. My cost base is around 25, so that's why I want to be around 24 or less. But I think anything under 28 is a pretty good deal for this company overall. Now, like Corsair Gaming, Sprouts does come out with their earnings this week, so it'll be interesting to see what they do. I've also done previous videos where I do think Phil Town is buying into the company because we found out he did some option contracts last quarter. So I think here in the next couple of months, we're going to find out that he actually bought Sprouts, and that might move the stock. We'll kind of see what happens from there. But those are my thoughts, guys. What do you think about these three companies, Corsair Gaming, Alibaba, and Sprouts Farmers Farmers Market. What stocks are you buying August 2021? I would love to hear from you guys. Drop a comment down below. Helps out the channel a lot. I'll be sure to answer each one of those. Thanks again for watching. Love you guys. I'll catch you guys on the other side. Take care and God bless.